Chapter 2. The Day the System Broke. Narration. For decades, the global financial system appeared stronger than ever. Banks were growing. Credit was easy to obtain. Home prices seemed to rise year after year. The economy looked healthy. But beneath the surface, something dangerous was happening. Banks had discovered a new way to make money. Traditionally, when a bank approved a mortgage, it kept that loan on its books. If the borrower couldn't repay, the bank absorbed the loss. That system encouraged caution. Banks had a reason to make responsible loans. But during the early 2000s, that model changed. Instead of holding mortgages, banks began packaging thousands of them together and selling them to investors around the world. These financial products became known as mortgage-backed securities. The idea seemed brilliant. By combining thousands of mortgages into a single investment, risk appeared to be spread across many borrowers. On paper, it looked safe. In reality, the risks were becoming harder to see. Because banks no longer expected to keep the loans, many became less selective about who received them. Mortgages were approved for borrowers with unstable incomes. Some buyers purchased homes they simply couldn't afford. Others received loans with low introductory payments that would later increase dramatically. As long as home prices continued rising, the system appeared to work. People who couldn't afford their payments could simply refinance or sell their homes for a profit. Everyone assumed the market would continue climbing. But markets don't rise forever. By 2007, home prices began falling. At first, the decline seemed manageable. Then more homeowners started missing their mortgage payments. Foreclosures increased. The value of mortgage-backed securities collapsed. And suddenly, institutions across the financial system discovered they were holding assets worth far less than they had believed. Fear spread rapidly. Banks became uncertain about their own balance sheets. More importantly, they became uncertain about everyone else's. Every day, banks lend enormous amounts of money to one another. It's one of the invisible systems that keeps the global economy moving. Businesses rely on those loans. Consumers rely on those loans. Entire economies rely on that confidence. But confidence was disappearing. Banks stopped lending. Credit markets froze. Companies struggled to finance daily operations. Investment dried up. The financial system wasn't collapsing because money had vanished. It was collapsing because trust had. Then came September 15th, 2008. Lehman Brothers filed for bankruptcy. Founded in 1850, Lehman had survived the American Civil War, the Great Depression, 2 world wars, and countless financial panics. Yet it could not survive this crisis. Its collapse shocked investors around the globe. If an institution that large could fail, what else was at risk? Markets plunged. Television networks interrupted regular programming. Governments called emergency meetings. Businesses delayed hiring. Families delayed major purchases. The uncertainty spread far beyond Wall Street. Within weeks, the effects reached nearly every corner of the global economy. Factories slowed production. International trade declined. Unemployment surged. Millions of families watched retirement accounts lose years of growth in just a matter of months. Governments and central banks faced an impossible decision: allow the financial system to collapse, or intervene. Many chose intervention. Banks received emergency support. Interest rates were cut to historic lows. Central banks injected vast amounts of liquidity into financial markets in an effort to prevent a complete economic collapse. Supporters argued those actions saved the global economy. Critics argued they encouraged excessive risk-taking and created long-term consequences that would be felt for years. Even today, economists continue to debate those decisions. But regardless of where you stand, the crisis changed something much deeper than financial markets. It changed public confidence. For the first time in generations, millions of people began asking uncomfortable questions. Who controls money? Why do banks hold so much power? Can governments create unlimited currency? And perhaps the most important question of all, could there be another system? While the world searched for answers, an anonymous programmer believed he had one. On October 31st, 2008, a 9-page document quietly appeared on an obscure cryptography mailing list, Almost no one paid attention. But history would.